Well, there's a sense in which that is a very deep question. Because people, in a bubble, people get caught up in self-reinforcing expectations of rising prices. Prices are going up, that reinforces their expectation that prices are going to continue to rise, and then they buy, and that helps to reinforce the increase in prices. But the fact is, people do this, and it's not new. It goes back a couple of centuries. It happens over and over again, so that I think a more interesting question is whether we can, in the current housing bubble, identify any triggers, anything that kind of may have helped to initiate it. And, well, prices, our previous bubble peak was 1989. Prices fell clear down gradually until 1997 and then started up. And we think that a key event in 1997 was the Tax Relief Act. And what that did was enabled home buyers to enjoy a tax-free capital gain on a home up to $500,000. And so we see that as greatly sweetening the incentives for people to invest in homes and not other types of assets. This one asset was chosen, was picked out, you see, and treated in a way that really gave people incentives to buy homes. And we think that was an important initiating cause.
One of the factors that hasn't received so much attention is the inflow of money from foreign countries. In 1997, the U.S. trade deficit was around $150 billion per year, and by 2005 it had reached close to $800 billion a year. And when we looked at the net flow of mortgage funds into the market, and we found a figure of about $2.5 trillion. And during the period from 2001 to 2006, we had $3.5 trillion flow into the United States economy from abroad in the form of current account deficits. So that inflow of money from abroad provided a lot of funding for U.S. investment banks and U.S. banks that needed to be put into some good investment. A lot of it ended up taking the form of mortgage securities, and that really was a major contributor to the housing bubble. One of the things that Vernon and his collaborators have found over the years in asset market experiments is that when you provide more liquidity into an asset market, you get bigger bubbles. And that was certainly the case here.